Somebody in Washington made a calculation last year that went something like this. Canada sends roughly three-quarters of its exports to the United States. Its oil system was built around U.S. buyers. Its factories were built around U.S. supply chains. Its political class spent decades treating U.S. access as permanent. So if Washington hit Canada hard enough with tariffs, Ottawa would fold. That was the theory. That was the leverage. And right now, the evidence says that theory has started to break, because the best supported version of this story is not that Canada escaped pain. It did not. It is that Canada has already recovered nearly $11 billion of an estimated $18.5 billion hit by redirecting trade through 27 partners, while the share of Canadian exports going to the U.S. has kept shrinking. And that is the part every American paying attention to trade should sit with for a second, because this was supposed to be a pressure campaign based on dependence. Instead, the more pressure Washington applied, the more incentive Canada had to accelerate a diversification push that was already underway. Not everywhere, not all at once, and not without friction, but fast enough that official Canadian data, Reuters reporting, RSM analysis, and a Globe and Mail breakdown are all pointing in the same direction. U.S. leverage is not disappearing, but it is getting weaker than the tariff architects expected. Nearly $11 billion recovered, 27 trade partners tapped, and $18.5 billion exposure partially offset far faster than most people in Washington seemed to think was possible. And the man at the center of that shift is not a celebrity CEO and not some Silicon Valley savior. It is Mark Carney, a central banker turned Prime Minister who has spent years talking about resilience, exposure, fragility, and what happens when systems that look efficient on paper become dangerous under geopolitical stress. That does not mean he scripted every outcome. It does mean he came into office with a worldview built for exactly this kind of pressure. So the verified version of the headline is even more interesting than the clickbait version. Canada did not magically replace the United States. It did something more important. It proved that the U.S. market is no longer the only emergency exit. That is a very different story from Canada is fine. Canada is not fine, but it is adapting. And in trade wars, adaptation is the difference between getting squeezed and getting permanently rerouted. Before we get into the full story of how Canada pulled off one of the sharpest recent moves away from US-only dependence, make sure you subscribe and hit that bell right now, because this is not just a Canada video. This is a leverage video. It is about what happens when a tariff strategy is built on the assumption that the other side has nowhere else to go, and then the other side starts building exits in real time. And if you are an American watching prices, markets, supply chains, or retirement exposure, this matters to you more than Washington's talking points are letting on. The number Washington does not want you staring at is not the tariff rate. It is the exposure estimate behind the strategy. Roughly $18.5 billion is the hit the competitor script centers on, and the Globe's reporting says Canadian firms have already recovered nearly $11 billion of that by tapping 27 trade partners. That does not mean every sector got rescued. It means the original assumption that Canada would remain trapped inside one market long enough to be forced into concessions is already under stress. When almost $11 billion gets rerouted or replaced before the pressure campaign has fully matured, that is not a footnote. That is the story. And the reason that story matters is simple. Tariffs only produce maximum leverage when dependence stays frozen. But dependence is not frozen anymore. Reuters reported that the U.S. share of Canadian exports dropped to 72% in 2025 from 76% the year before, while exports to non-U.S. destinations surged 17% over the full year and hit all-time highs by December. In other words, even before you get to the March shock data, the baseline had already begun to move. Now, to be fair, the leverage case was never irrational. Canada really was deeply exposed. RSM noted that exports to the United States had consistently accounted for about three-quarters of Canada's total exports, while a staggering 97% of Canadian oil exports were going to the U.S. before new diversification routes started opening. In autos, the system was so integrated that cross-border manufacturing was not just normal, it was foundational in agriculture, metals, and energy. Entire regional business models were built around the assumption of stable U.S. access. So yes, Washington looked at real vulnerability. What Washington appears to have underestimated was the speed at which vulnerability can become motivation. Once the rules no longer feel stable, the incentive changes. Exporters stop waiting for a return to normal. Governments stop treating diversification as a nice-to-have. Infrastructure that once looked optional suddenly becomes strategic. And that is where this story stops being about rhetoric and starts being about mechanisms, because Canada's answer was not one magic policy. It was a stack of moves that made alternative trade routes more real than they had been at any point in recent memory. Here is how he did it. Start with Trans Mountain. The Canada Energy Regulator says the Trans Mountain expansion came online in May 2024 and nearly tripled system capacity to 890,000 barrels per day. Since startup, roughly 80% of capacity has been committed. The system has averaged more than 75% full almost every month, and crude exports to countries other than the United States have more than tripled. That last line matters. Because once Western Canadian crude had a serious route to Tidewater, Asia stopped being a talking point and became a scalable outlet. That does not mean Canada replaced the U.S. refinery system overnight. It means the old you have nowhere else to go argument got weaker the moment the Pacific outlet became commercially real. The regulator says an average of 23 vessels per month departed Westridge between June 2024 and July 2025, and Reuters later reported that Canada's exports on U.S. destinations were hitting all-time highs even as the U.S. share kept sliding. So when people say Carney replaced $11 billion, the sober translation is this: Canada used infrastructure, pricing relief, and market access to reduce the amount of damage Washington could reliably inflict. And oil was not the whole story. The broader pattern was exporters moving into multiple markets faster than the old model assumed they could. That is exactly why the March data hit so hard. By the time Washington was still thinking in terms of bilateral pressure, Canadian firms were already pushing into a wider, more distributed map of buyers, contracts, and counterparties. Not perfectly, not permanently, but measurably. Then came the move that changed the strategic math. In January 2026, Carney traveled to Beijing, the first visit by a Canadian Prime Minister to China since 2017, according to Reuters, and announced what he called a preliminary but landmark trade arrangement to reduce barriers. Reuters and the Prime Minister's office reported that Canada would allow up to 49,000 Chinese electric vehicles in at a 6.1% most favored nation tariff rate, while Ottawa said it expected China to lower canola seed tariffs to about 15% from 84% and to remove anti-discrimination tariffs on canola meal, lobsters, crabs, and peas. Reuters later confirmed Chinese buyers had already booked Canadian canola cargoes after the trip, while China officially suspended some agricultural tariffs by late February. And then the escalation went political. Reuters reported that Trump initially said, "If you can get a deal with China, you should do that," before later threatening a 100% tariff on Canada if Ottawa turned into what he called a drop-off port for Chinese goods. Carney, meanwhile, said at Davos that Canada had signed 12 other trade and security deals on for continents in 6 months, and that diversification was not just economic prudence but the material foundation for honest foreign policy. That is the real pivot here. This is no longer a story about one bilateral argument. It is a story about Canada trying to engineer bargaining room before the next round lands. And now drop a comment right here and tell me this. When this trade war started, did you think Canada would be pushing deeper into Europe, using a Pacific oil outlet, cutting a new arrangement with China, and openly talking about a world where middle powers have to hedge against economic coercion? Because that is what makes this story so politically dangerous in Washington. It is not just that Canada got hit. It is that Canada started adapting in public. Now let us get to the data Washington cannot spin away. Global Affairs Canada's March 2025 trade report says exports to the United States fell 6.6% in March, while exports to other markets jumped 24.8%. RSM called that the second largest increase in recorded history for non-U.S. merchandise exports and the largest drop in exports to the U.S. since the height of the pandemic in 2020. Those are not vibes. Those are not campaign lines. Those are official trade numbers plus independent economic analysis saying the rebalancing is real, even if some of the monthly surge was concentrated in gold. Reuters adds the longer arc. By December 2025, exports to countries other than the United States had reached an all-time high. The U.S. share of Canadian exports fell to 67.4% in December, with the full-year share dropping to 72% from 76% a year earlier. That is what backfire looks like in the real world. Not a total collapse of U.S. power. Not some fantasy where America no longer matters. A narrower thing, but still a serious thing. Each month Canada diversifies, Washington's threat loses a little bit of force. And the analyst estimate that anchors the headline fits that trend. The Globe's trade analysis says Canadian firms tapped 27 trading partners and recovered nearly $11 billion of the $18.5 billion loss tied to the U.S. shock. That does not mean the whole economy is suddenly de-risked. It means the effort was broad enough and fast enough to move from theory to measurable offset in a trade war built on the assumption that Canada would just take the hit. That is a strategic failure for Washington, whether officials admit it or not. Here is what this means for you as an American. The tariff strategy rests on a simple belief. Canada needs the U.S. more than the U.S. needs Canada. So pressure will eventually force compliance. That belief still contains truth. But it contains less truth than it did a year ago. Reuters, RSM, and Canadian official data all point to the same emerging reality. Canada is building more options, and every new option reduces the credibility of future threats. If Washington wants to use market size as a weapon, it has to move before the target builds workarounds. Canada has been building workarounds. And Canadian exporters are not behaving like businesses waiting for the old world to return. EDC said in its Winter 2026 Trade Confidence Index that 65% of exporters plan to enter new markets over the next 2 years, and that the share of companies starting their export journey in multiple global markets had more than tripled over the past decade, from 13% in 2015 to 43% in 2025. That is not panic behavior. That is adaptation behavior. That is a private sector signal that diversification is moving from emergency response to business model. Which means the real risk for Washington is not one bad month. It is path dependence in reverse. Once firms build new shipping relationships, new compliance routines, new counterparties, and new expectations, trade patterns do not simply snap back because somebody gives a speech. They compound, they normalize, they harden. And if you are an American voter being told tariffs create leverage automatically, this is the evidence you need to watch. Not the announcement day, but whether the target country is getting more dependent or less. Canada right now is getting less. Carney said at Davos that the old order is not coming back, and whether you agree with him or not, Canada is governing as if that is true. He said his government is rapidly diversifying abroad, cited 12 trade and security deals on for continents in 6 months, and framed diversification as the foundation for sovereignty under pressure. Pair that with the Globe's nearly $11 billion recovery estimate, Reuters reporting on the falling U.S. export share, the March 24.8% jump tune on U.S. markets, and the China reset, and the title starts to make sense in its strongest verified form. Canada has not beaten the United States, but it has already beaten the assumption that it would have no alternative. And that is why this story matters beyond Canada. Trump mocked Canada, threatened more tariffs, and even said at Davos that Canada lives because of the United States. But the data says Canada is trying to build a future where that line gets a little less true every quarter. If this gave you the full picture, the picture that's scattered, coverage hints at but rarely assembles in one place, share it with someone who still thinks tariff power stays fixed forever. Because the story of Canada replacing nearly $11 billion is really a story about what happens when the weaker side starts building exits faster than the stronger side expected. We will be right here covering every development. Stay tuned and stay informed.